In my paper, Does Banking Competition Really Increase Credit for All? The Effects of Bank Branch and Deregulation on Small Business Credit, I explore two main questions. The first question is about how and why banking deregulation that increases competition within local markets impacts small business lending. And the second question is to what extent credit constraints impact the operations and survival of small businesses. Regarding the first question, I find that certain sectors of the economy can be negatively impacted by deregulation. Specifically, I show that the supply of credit to small firms can decrease as a result of interstate branching deregulation. This is an interesting result because it is at odds with the large and important literature on banking deregulation, which started with papers by J. Ratney and Strahan in the 1990s that document unambiguously positive effects of deregulation. The difference in results between my paper and the existing literature comes down to the period of deregulation studied. The positive results in the literature overwhelmingly come from studying what I call the first wave of interstate banking deregulation, which occurred between 1978 and 1993. During this period, bank holding companies could acquire out-of-state banks but not create new branches across state borders. This allowed for a measured expansion where the most well-run bank holding companies could acquire less well-run or failing banks. This naturally led to the positive effects documented in the literature. In this paper, I focus on the second wave of banking deregulation, which began after the passage of the Interstate Banking and Branching Efficiency Act, or IBBEA, in 1994. This form of deregulation allowed banks to much more indiscriminately expand across state borders. However, states could pass their own laws to limit the ability of out-of-state banks to open new branches in their states. The extent to which they did is captured in a branching restrictiveness index developed by Johnson and Rice in their 2008 paper, which ranges from 0 to 4. Lower values indicate that it was easier for a bank to enter local markets within that state. This is what I use in the paper for identification. Using a generalized difference in difference specification with multiple levels of treatment, I find that a 1-unit decrease in the BRI caused a permanent increase in the number of branches of about 2% in the local market, with the initial shock leading to a 14.9% increase in branch births of banks headquartered outside of the state, along with a 4.1% decrease in the number of existing branches of banks headquartered in the same county, an indicator of very small local banks. Additionally, I showed that the vast majority of the new branches were associated with larger banks. I showed that these larger out-of-state banks were able to gain deposits in the local markets at the expense of the existing branches. As a result, they took away funding from the traditional relationship lenders, which led to a decrease in the supply of credit of about 5.4% on average in treated markets. In interaction regressions, I showed that the decrease was even larger in areas with more deposits and higher home price growth. This indicates that some banks were entering markets to chase cheap funding or to originate mortgages at the expense of their small business lending portfolio. Motivated by the results of the first question, I next studied the extent to which the decrease in credit impacted firms' operations and survival in treated markets. In the paper, I showed that the number of small businesses does decrease around 5 years after deregulation, but that the magnitude is quite small. Instead of closing, I find that the decrease in the supply of credit caused firms to shrink their operations, reflected in their decreased demand for labor. Using a triple diff model, I find that compared to large firms, the smallest firms with fewer than 51 employees reduced their full-time worker employment levels by 4.5% and full-time worker hours by 5% per unit of the BRI directly after deregulation. Contemporaneously, there was no statistically significant change in full-time employment or hours worked at large firms, although there was a 2.4% increase in all hours worked at larger firms, indicating a potential shift from full-time work at small firms to part-time work at large firms. Despite the temporary nature of the credit supply shock, full-time employment and hours worked remained about 3% lower in the smallest firms 8 years after deregulation, showing the long-run impact that a shock to small business credits can have. Along these lines, I find that although wages remain stable for the decreased workforce at smaller firms, the increased supply of workers was associated with about a 0.5% decrease in wages at larger firms, which is consistent with a positive labor supply shock to these firms. Overall, this paper gives a different perspective on banking deregulation, showing that how the deregulation is implemented matters. The ability of larger, out-of-state banks to quickly enter new markets in order to chase deposits and originate mortgages disrupted the supply of relationship loans from existing banks. This allowed me to study the impact of credit constraints on small firms. I found that in general, these firms can survive a credit shock, but that they respond by decreasing their demand for labor, which precipitated a shift in labor from smaller to larger firms. Thank you very much.